Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 103rd VideoCast and 93rd podcast for the week ending October 7th, 2021. This is Thursday. We'll kick it off quickly with the media and head right down to the meat and potatoes. A lot of nice developments this week. First off, I'd like to thank Ellie Terrett and Cheryl Cassoni for having me on the Clayman Countdown on Friday. We discussed the October outlook and some stats, which we'll go into later in the call, as well as a couple new picks, reopening picks that I think you'll find exciting. And also thanks to Liz Clayman as well, as it's her show. And I think she's back next week, so tune into the Clayman Countdown next week for sure. And then I want to thank Devik Jain and Amber Warwick for including me in their Reuters article last Friday as well. This was about the Merck pill. I said the market is viewing this as a very positive development as it gives people confidence that the reopening is not going to get derailed despite breakthrough cases with vaccines. And the data looks very, very good. And even Scott Gottlieb, who's on the board of Pfizer, former FDA commissioner, has been singing its praises, saying that we haven't seen data on an antiviral like this ever, basically, and that obviously there's two more behind it. Pfizer's got a COVID pill coming, and one other company has got a COVID pill coming as well. So that's very, very positive news. And then just a couple of days ago, also want to thank Sriyashi Senyal and Devik Jain for including me in their article. My quote was, in the rising rate environment, historically you've been rewarded being in the economically sensitive value and cyclical stocks relative to tech. That's not to say tech will collapse. It's just to say that cyclical should do better in coming months, said Tom Hayes. Markets are really focused on Washington and the uncertainty of their being unable to come to an agreement on the infrastructure bill, social spending plan, and raising the debt limit. So that got alleviated in the last 24 hours, pushing it off to December. So that was positive to see. This is our new addition to the family. Her name is Lucky. She is a Shih Tzu Poodle combination. They told me it's a Shih-Poo. I thought it was something else when I first heard the combination. You can figure out what I thought it was, but nonetheless, it's a cute, great dog. The girls love her, and it's a good thing. All right, moving on to oil and OPEC. Oil was up this week on OPEC, moving up their production in line with their predetermined plan of 400,000 barrels a month. Some people had been looking for 800,000 barrels. It didn't come to pass, and therefore OPEC is back in the driver's seat of global energy prices with the new administration, and we are seeing the $4 and $5 at the tank in some parts of the coast, which, in some sense pales in comparison compared to what they're experiencing in Europe, trying to transition to renewables too quickly. When the wind doesn't blow, you have a problem. The technology will pick up. The transformation will happen. Those who think it won't happen are silly. Buffett put it best. Those who think that the energy transition won't happen are ridiculous, and those who think it will happen quickly are ridiculous as well. So there's a lot of gas in the tank, pun intended, for many of these energy companies, and it's a great inflation hedge as well. They have had a nice run here in the short term, so you may see some profit taking where, if you get something like, there's a lot of unfocused on rumblings about an Iran deal. We talked about it last week. Today, this came out over the wire. U.S. State Department says imminent return to Vienna nuclear talks with Iran is needed. This cannot go on indefinitely. So I think that's in line with, they want to take oil prices down, and Iran will put a big supply on the market once some of the sanctions are lifted. Iran says, sure, we'll talk. Just give us $10 billion before we get to the table. And the administration has said no comment. So my guess is Iran is going to get a lot more of what they would want from the current administration than they would from the previous one. And that may take a little bit of short-term steam out of the energy market in coming weeks if there's progress But the trend for the next 3 to 4 years is constructive for these companies, the natural gas producers, oil producers. And we talked last week about being a little more selective. If you missed the huge move up in E&P, maybe there's still some opportunity on the downstream refiners and some opportunity in the midstreams if you missed it and you wanted to get some sector exposure. On to China. Obviously, one of the stories this week was the Beijing flying 93 military sorties near Taiwan. That achieved the desired effect, which got Biden on the phone with Xi asking for a meeting. Xi is now going to take that meeting virtually in the next couple of months. The market liked that overnight, and China tech stocks had the biggest surge since August overnight. You can see right here in this table. So that was a huge thing, a lot of short thing. And as I'd said over and over, when these things turn, they're not going to let anyone in, and it's going to be abrupt. And we just don't know when, and we don't know the timing, and we don't know the catalyst. But when it turns, it's going to turn hard, and we saw some indication of that. BABA's up the last 3 days. Today was a big day for BABA. Was up 11 points, 8.2%, and not just being up because it was up on nearly 2 times average daily volume. So the last month average volume is 22 million shares. It was up 11, almost 12 points, 8.25% on 45 million shares. So that's a big deal. A lot of buying today. So we'll see how that follows through in coming weeks. And then Xi, this is from Bloomberg. Xi picks opportune time to cool tensions with Biden meeting. He's grappling with a series of challenges at home now, and both sides seek middle ground that pleases domestic audiences. So he's got the whole Evergrande thing going. He's got preparing to host the Olympics during a pandemic, and battling an energy shortage. He needs some of our goods now. So that's a positive thing, and there's no greater way for parties to come together when they both need something from one another. That should bode well for Boeing. That should bode well for energy companies exporting, and possibly farmers, and I think China tech stocks. I think that the circular firing drill has taken a pause. They've stopped destroying their own for some time, and the market is responding. The other thing, obviously, which we're going to cover quite a bit of, is what happened with Charlie Munger this week. Nearly doubled his Alibaba position. So we'll go into that in some detail as we move forward. General market, Marko Kolanovic over at JP Morgan. He's a strategist I do follow. I think he says a lot of thoughtful things, particularly because he frequently agrees with me, but and when he disagrees, I pay close attention. He made this headline today. He said markets can handle $130 oil and 2.5% yields. I agree with the latter. For sure, the market can handle 2.5% yield on a 10-year, and I think we're going to go there or close to it, probably 2 to 225 by Q1 in anticipation of taper. We've covered that a lot in recent weeks. 130, his basis is like from 2010 to 2015, oil averaged over $100 a barrel, and the economy did just fine. So I think that's a reasonable point of view. I get a little cautious when everyone starts calling for $100 oil. Sometimes I worry that that's kind of the meat of the short-term move may be behind us, and then you get something like Iran takes $5 or $10 out of a barrel, the stocks correct 5 or 10%, everyone pukes out, and that's the next time to reload. So if you have them, hold them. If you don't have them, midstream, downstream, yes. Upstream, very, very selective. Wait for some type of catalyst here because everyone's getting a little too excited. When we were excited last year, no one wanted them and they thought it was silly. Oil is negative 40 for a day. and now everyone wants them. Same with banks. All these guys are talking how high quality banks are, and the same ones that were on saying, banks are a joke. Who needs, pens with chains on them in the branches when DeFi is going to take over the world? So opinion follows trend. It's followed trend on oil now, and you're going to see it in Chinese stocks in coming weeks. You still have your huge skeptics out there. And justifiably so. It's been a pounding for sure. But some people were puking and others were adding, and that's what makes the difference when all is said and done. Carnival to restart more cruises from U.S. ports in January and February, expects 100% capacity use in the spring. This is something we talked about on the Clayman Countdown a couple weeks ago when we were talking about United Airlines and Carnival. The reopening trade, the leisure, I think these are still cheap, so buy the dip, so to speak. General market overview, put call, 10-day moving average still elevated. That's good to see that fear. That means this bounce is probably for real, and we probably will see some follow through. Maybe we'll get some hiccups with the politics, but on balance, I think the worst is behind us, and in line with what we had expected all year, which was pullbacks would be contained to 3 to 5%, and that has held through on a closing basis. So it's nice to see that right up to the edge and then turned around. All of these are still near buy areas versus sell areas. This is all constructive, and we covered a lot of these last week. Even the NASDAQ, some of them are getting attractive, even though we think cyclicals will outperform relative to tech. Some of these tech stocks are getting a little overdone, and that'll also help on the Alibaba, although it's been uncorrelated to U.S. tech. I think we're going to see, you're seeing materials pick up here on the bullish percent. There was one other this one, healthcare. Healthcare stocks above their 20-day moving average, exponential moving average. Man, this is like where it was during the pandemic. This is an opportunity, and that's why we like things like Cigna. Some of the drug stocks are getting cheap. Amgen, Bristol Myers. We would consider, if you remember, we had Pfizer from 33 up till 48.50. We were out. It went up to 50 without us, another 1.5, and now it's collapsed down to 42. We would consider picking up Pfizer again, in the 40-41 range. No rush there. But they do have a Lyme vaccine coming down the pike. They do have a COVID pill. They do have the kids' vaccines, and they are going to have that recurring income stream moving forward, which is known. But I think at $40, it becomes compelling again for a long-term hold, not a trade like last time. Again, intermediate term Dow. Again, this is a buy area, not a sell. Same with the NASDAQ intermediate term. McClellan summation, these are areas where you want to buy. National Association of Active Investment Managers, I said in my article this morning, this was down at 55. Managers are going to have to chase if we get a bounce into year end, and they're starting to do that. It ticked up to 68. I guess it printed this afternoon. PMO buy all. This is an extreme that is to be bought at these levels. We covered that last week when it was at 0. It's starting to get bid. Same with PMO by Dow Jones. By SPS, S&P 500. They're all pointing to the same thing, which is there's opportunity. You may get a couple hiccups, but you got to be net adders. And it was to be net adders in the last 2 weeks, even despite the market was getting weak. The groups we were looking at were holding strong, and many of them were moving up even in a weak market. So the NYSE McClellan here, you can see the skews come down. People have stopped taking the bets on the catastrophic risk. So that's interesting. And then, so that's basically the story there. I like this quote from a guy named Michael Covell. Trading is a waiting game. You sit, you wait, and you make a lot of money all at once. And that is true. I mean, when you get into managing portfolios, you can go like over this summer, it was like a Chinese water torch. The market just grinding sideways. Small caps, all the reopening stocks just doing nothing. The Chinese stocks just getting hit every day. And then all of a sudden when these things turn overnight, it's just like, the equity curve goes through the roof. And you're going to see that in your career that, when you have 100% years, you're going to see that the majority of that comes in literally 2 months, 2.5 months plus. And I thought that was an appropriate quote. Okay. These are the stocks that we laid out on the 16th when everyone was worried about the September swoon. And I said, look, these things already had a summer swoon. Take a look at what's beaten down as we go into the end of the year and what can happen. So, you saw these type of Credit Corp has had a huge run, 105 to 125. BABA up today, almost 12 points, 8.25% in a day. Finally, Suncor from middle September has taken off from, 18 to 22. Discovery starting to take off. VF Corp, it's been building this base for 2 weeks. It's now starting to get a bid. Uber absolutely ripped right after that, literally the day after. Viacom's building a base. That thing could take off. So these are just, MasterCard was having trouble. It jumped. It came back. Now it's jumping again. Centene is starting to take off. Dollar Tree ripped from 85 to 98. Downstream, Phillips 66, literally to the day from 65 to 79. So Fleet Core, ripped, came back, it's ripping again. Las Vegas Sands hasn't ripped yet. I love this. I love Las Vegas Sands and I love Wynn. I covered it last week on the Clayman Countdown with Shaul Cassoni. Watch that video. We're going to talk a little bit about it, but this one's still cheap. It hasn't moved since the 16th, more or less. So there's still opportunity. J&J, still opportunity. Cigna started to jump today. Wait, is this weekly? This is daily. Yeah, so Cigna had a move today. I think these are going to rip. Boeing ripped from the 16th. It's up from 210 to 226. There's a lot more there, both in Cigna and Boeing in our view. Lockheed Martin also ripped from the 16th, from 340 to 351. So these things are starting to get going. Even Clorox is starting to, we'll see what happens with that. So, across the board, there's still value. You got to know where to look. Even General Mills from 58 to 61, which is a big move for that stock. So they're all starting to move. There's still value. And that leads us to our article of the week, which is the Buy Dirt stock market and sentiment results. In recent weeks, we commented to stop worrying about a September swoon, as most pullbacks would be contained to 3 to 5%. It's held true on a closing basis. In contrast, we suggested shifting focus from the general indices and buying quality that was on sale and already experienced a summer swoon. When I saw the lyrics to Jordan Davis and Luke Bryan's country hit, Buy Dirt, I could empathize with the strategies. So he's talking to this older guy, and the lyrics are, a few days before he turned 30, he was sitting back in a rocker. He said, what have you been up to lately? I told him, chasing a dollar, and in between sips of coffee, he poured out his wisdom and said, quote, if you want my 2 cents on making a dollar count, buy dirt. And then later phrase, he says, because the truth about it is it all goes by real quick. You can't buy happiness, but you can buy dirt. And the literal meaning of this suggestion is to buy land, build a house, and a life around it. As it relates to the stock market, I view it as buying value with immense raw intrinsic value when it's on sale and waiting for that inherent value to be realized by the market over time. So we're not talking about gambling stocks and, small or micro cap. There's a place for that. You manage that by size, et cetera. But, when a Lockheed Martin is down 25% and estimates are going up at the same time, when an Alibaba is tripling its business in the last 3 years and going to double its business over the next handful of years and is trading cheaper than before it grew 3 times, these are, with 1 billion users, that can't be replicated. These are the type of situation. Wells Fargo, when it was trading at a 50% discount to book value, it's only done it 2 other times in history. Same thing with ExxonMobil last year. These type of opportunities come up from time to time, and you can't, you have to take advantage of them. And what makes them great opportunities is that when you're buying, you're alone because everyone else is puking. That's what got it to that valuation. You have to know you have to know what you own. You have to know the franchise well enough. You have to understand the fundamentals well enough to be sure that the price is detached from the underlying business due to emotion or short-term headwinds, not permanent structural headwinds. And that's the nuance. And that is, and when highest quality franchises drop 50%, people are making bets that it's structural, and 80% of the time it's cyclical. As we saw with energy over the last year when everyone said oil is over, just like they said tobacco was over in 1960, and the tobacco stocks over the next 40 years were among the best performers, and even in the last 20 years they've had outstanding performance. So leaving that aside, this week we saw a very interesting public filing from Warren Buffett's partner Charlie Munger. Charlie and Warren did not become billionaires buying fully priced, quote, shiny skyscrapers when everyone wanted them. They got rich buying dirt and seeing the intrinsic value in a high-quality company when no one else did and no one else wanted them. So earlier this year, Charlie Munger, through his investment vehicle, the Daily Journal, bought Alibaba. His first purchase was in Q1 of 2021, reported on April 5th, 2021, because they report after the quarter closes. So this means his initial purchase of Alibaba, which was 165,320 shares, was priced between $220 and $274. My guess is it was closer to the low end of the range, as he would have been buying the panic selling off the $319 high in Q4 of 2020. So it was down, at 220, it was down about a third. It probably made a lot of sense. And it did make a lot of sense. If you look out 3 years ago, anyone who bought it at 220, 230, it's an absolute monster home run. It'll be a $400 stock. Whether that's 3 years out or 4 years out, we don't know. But nonetheless, that's what his first slug came at. In Q2, Baba continued to fall as the regulatory crackdown ensued. Alibaba paid a $2.8 billion fine for, quote, monopolistic practices. Baba traded between $204 and $245 in Q2. Munger did nothing. He did not add further on the weakness in Q2. And then in Q3, the Chinese government, communist government, started aggressive crackdowns on education providers, online gaming companies, real estate companies, and any other target they could think of. It was a bureaucrat's wet dream, is basically what happened in China in Q3. And foreign investors fled the arbitrary and capricious government actions by voting with their dollars and exiting stage left. And capital goes where it's treated best, and it was not being treated well in China. With one exception, Charlie Munger decided to nearly double down on his position in Alibaba, taking his shares from 165,320 to 302,060. So Baba traded between $228 and $146 during Q3. This aggressive purchase likely took Munger's basis from, my guess would 220, 230 down into the probably closer to 200 range, $180 to $200 range. It's now 17.59% of his portfolio. And our stock position basis is now materially below this range, as we started our position much later than Munger and have added nicely on recent weakness. So where did we get the funds? We're fully invested most of the time. So to raise the funds for this unique opportunity, we simply shaved a bit from each of the gainers in the portfolio that no longer have the 60 to 90% upside potential over the next 18 months. That's our view on Baba, that we believe Baba has from these levels. And it was simply an analysis of best use of capital. Shaving Netflix after the run it's had in the last couple of months since we suggested it. And some others. You do these things because I don't think Netflix is going to move 60 to 90% over the next 9 to 18 months. I do think Baba can. So does it mean I don't like Netflix? No, but it means that I think Alibaba can do better. And some of the others that we had to shave from, a little bit shaved from financials. We love financials, but a lot of the financials have moved 100%. We don't think they're going to move 60 to 90% in the next 9 to 18 months. So we're able to put that money into Baba at very, very low levels. And we're excited about that. So why was Munger nearly doubling his position while everyone else was puking theirs out? For starters, successful people do what unsuccessful people won't. He's willing to take some short-term pain for long-term gain, not on the basis of wishing or hoping, or I hope it works out, I hope Tom's right, but on the basis of facts and data. The fact is he realized he could buy a business that has more than tripled in the last 4 years for less than it cost before the growth happened. And on top of that, the business is expected to double again in the next few years. So while the noise scared most people out, the business continued to grow top line aggressively and unabatedly, and cash flow will more than double in the next few years, yet you pay less than most folks did 4 years ago when the business was a third of the size. So will Baba face competition moving forward and regulation? You bet. Can its $1 billion be replicated? Unlikely. That's what we call a moat. And that's why Buffett and Munger are the best investors around, have been and always will be in my book. They're traders that come and go, but these guys stand the test of time. And one thing is for sure, you'll never see them carried out in a stretcher. And that's the most important thing in this business. So what I did here is I posted the yearly revenue versus yearly revenue and estimates and the yearly EPS and estimates. So you can see their fiscal year runs ahead of the calendar year. So we're on fiscal 2022. Obviously, you're seeing earnings are going to took a little bit of hit recently just because of all the crackdown, but they pick right back up next year, and we're looking forward now to fiscal 2023 as we move into 2022 calendar. And you see here that estimates for 2026 are 120 yuan times 0.16 gives you about $20 a share in earnings on the ADRs. And at that growth rate, it should be at a 20-25 multiple, and that's how you get to 400 to 500 5 years out. And you continue to see revenues just exploding and completely unabated, by the way, by the regulatory crackdown. So that's good. Also, Munger's good friends with a well-regarded on-the-ground Chinese money manager named Li Lu. Lu manages some of Munger's personal money and is well-connected and knowledgeable about policy and business outlook in his local market. Li Lu actually got him in BYD, which is a Chinese battery maker. That's the good news, and it's up like, I don't know, probably about 7x in the last 24 months. That's the good news. The bad news is he got him in 10 years ago, so he had to wait. But the compound annual growth rate of that has been phenomenal. So anyway, if I can buy a business that's expected to double in the next few years and pay the same price as someone who bought it 4 years ago when it was producing a third of what it's producing today, what could go wrong, and why is it so underpriced? And this is a question that came in from, let's see, this was a question of the week. Okay. Joseph, first name only, regarding Baba. Your podcasts are an invaluable wealth of insight. Thank you for your generosity. You often counsel listeners to scrutinize the bear case for the companies they are most bullish on, a method you almost always practice in your own analysis. But when it comes to Baba, there seems to be a tendency to reduce the bear case to overblown irrationality no sooner than you lay it out. As much as I appreciate your eternal optimism on the company, I gotta ask, what's your most persuasive bear case for the house that Ma built? I love this question from Joseph, first name only, and I decided to address it in the article of the week. So what could go wrong, and why is it so underpriced? And we have covered this in past weeks, but I want to re-emphasize it. So what's the market concerned about? I mean, these people aren't puking it out while we're buying it for no reason. They have legitimate fears, and they could be right. But the market is concerned that the Chinese government will continue to regulate to a point that its future earnings power is permanently impaired. And we believe this fear is overblown because it would destroy China's global competitiveness It would discourage their citizens from having children in an economy with less opportunity, which is a key initiative of the Chinese government now. They realized that the one-child policy was a disaster because now they have an aging population like Japan did at their peak in 1989. And if they don't get the birth rate up very, very quickly, they could suffer a similar fate to Japan and killing off one of their greatest companies where, parents would say, oh, yes, China's going to be great 10 years from now. Let's have a lot of children. They'll be able to get great jobs and they'll have a better life than we do. That's the American dream. You always want your kids to do better than you did. And having companies like Alibaba, like JD, like Tencent is a major factor of pride for parents making a decision. Do they want to grow a family? Or if that capitalist part of the economy is going to go away and it's going to be more like Russia and more like rationing and rules, who would want to have a child into that type of environment? And I think they understand that, and it's in their interest to do so. And it would lead to, and if they permanently impair the earnings power of Baba and the like, it's going to lead to significant unemployment like they saw in the education sector and social unrest like they saw with Evergrande. And that's why they have to ring fence and bail out Evergrande to make sure that people get paid, because they were starting to protest outside the building. They want to get paid. There's an implicit state guarantee on it, and they want the government to back up the payments. Second, the market's concerned that all Chinese stocks will be delisted from the U.S. exchanges. Chinese ADRs have been in existence for 2 decades, and their futures questioned every 3 to 4 years when the Chinese indices correct 30 to 40% due to regulatory crackdowns and normal business cycles. The SEC intends to delist roughly 270 Chinese companies listed on U.S. exchanges by early 2024, unless they allow their auditors to be inspected. We don't believe this will become an issue for Chinese listings that have major Big Four, global Big Four auditors. In the case of Baba, they have the second largest auditor in the world. That's PwC, PricewaterhouseCoopers. And the review of such audits should be a straightforward if and when required over the next few years. Wall Street Journal quoted Alibaba CFO Maggie Wu said the company is closely monitoring the bill that aims to delist foreign companies from the country's stock exchange and anticipates that it, quote, will be able to comply with any new regulations. Wu said the company, quote, will endeavor to comply with any legislation whose aim is to protect and bring transparency to investors who buy securities on U.S. stock exchanges. Why do they care? Because it's the deepest capital markets in the world. And if you want to grow, and if you want liquidity, and if you want high multiples, you need to be listed there. Period. Over and out. Okay. Moving on to Fox Business last Friday with Cheryl Casoni. Thanks again to Ellie, Cheryl, and Liz for having me on. In this segment, I gave the October outlook. So October tends to be volatile, but here are some stats. Over the past 20, and some of these come directly from LPL Ryan Dietrich, so hat tip to them. Over the past, but they're also in the Stock Traders Almanac. I mean, everyone has these stats, but over the last 20 years, October was the 4th best month of the year. And where it gets its bad reputation is if you look back to World War II, it's the 7th best month. So over the last 20 years, it's the 4th best month. Which I didn't know that, and I was more in the camp of, since World War II, it's the 7th best month. September is actually the worst month. So after a 7-month win streak ends, as it did in September, average returns since World War II are a month later up 1.2%, 3 months later up 4.1%, 6 months later up 7.9%, and 12 months later up 9.5%. So strength begets strength. There's a lot of built-up strength. Q4 is the best time of year, averaging 3.8% for the quarter since World War II. And I made the case that with the Merck pill, global cases declining for COVID, and Fed signaling taper, the reopening value and cyclicals should regain the leadership position it had in Q1 of this year and part of Q2. Long duration earnings, tech growth become less valuable in the short term when rates are rising. And that, again, that doesn't mean that they collapse. It just means that cyclicals and value should do better on a relative basis. And we suggested when people are worried about them losing their license and concessions, we believe those fears are overblown. as Wynn has local partners who own 28% of Wynn Macau, so the government's unlikely to kill their own. And then Wynn Las Vegas and Encore are seeing strong booking trends into year-end in their U.S. properties, and their digital gaming and sports betting has a big runway in the U.S. Lockheed Martin, it fell 15% off its summer highs as the industrials aerospace sector fell out of favor. With the reopening trade back in play, we believe this stock can work back up to new highs over the next 6 to 9 months. It will earn 27% more in 2022 than it did in 2019, the last full pre-pandemic year, and yet it's trading at an 18% discount to its pre-pandemic highs. It trades at about 12.5 times next year's earnings. It pays you a 3.25% dividend while you wait. And that F-35 fighter pilot, it's the largest weapons program in history. It'll fuel earnings for decades to come. Again, an example of high quality when it's out of favor. Now, retail sentiment is still super fearful. Bullish percent came in this morning at 25%. That is historically an area you want to be a buyer, not a seller. When the retail is fearful, you want to be greedy. And same thing with the Fear and Greed Index. It's near an extreme at 28. Same thing with the National Association of Active Investment Managers, which we covered. While 10%, and this is very interesting because I've been holding my guns to this 3 to 5% since January. If you've been listening, I'd said we would get no more than 3 to 5% pullbacks this year, and probably a handful of them, and that's held true on a closing basis. Now, while 10% corrections are normal, they should not be a foregone conclusion just because we haven't had one in a while. That's everyone's case. Well, we're due for it. We're due for it. We're due for it. Well, this chart shows the last 41 years of market pullbacks, and in 21 of the last 41 years, we have not had a 10% correction. You can go through it year by year. So, more often than not, you don't get a 10% correction in any given year, and in any given year, it's a coin flip. So that's where we are. Could we get one? Could Congress do something crazy? Of course. You got to be prepared for anything happening at all times. But I think that in the face of what I'm going to discuss now, if we hit any further turbulence in October while the politicians go through their normal shenanigans, keep in mind the, quote, richest man in the world, Jay Powell, still has your back. And I showed the Fed balance sheet, obviously at all-time highs again last week. And more than that, I showed when the Fed signaled taper, they signaled taper in May of 2013. They started in December of 2013. And as you can see from the green line when they started, the balance sheet / liquidity still grew for many months with asset purchases and reinvestment. So taper started, the balance sheet continued to expand. And then after the taper was done, it still stayed elevated from reinvestment until they started pulling back liquidity, which was Powell's first mistake, but he learned quickly from his error when we had that huge washout in December of... was it December of 18, I think it was. He was new on the scene, and it was a complete disaster what he did. But nonetheless, he learned quickly, saved us from a Great Depression last year, so all is well, all is forgiven, and God willing, he'll be reappointed if the administration knows what's in the interest of basically everyone. So, okay. So, if the Fed tapers $15 billion a month starting in early 2022 over an 8-month period, the Fed will add another $660 billion to its balance sheet. So you'll see something like this here while the taper's going on. Keep in mind, the S&P 500 gained 32.59% in 2013, anticipating the taper. Remember, they signaled in May, they implemented in December. So the market went up during that period. And while they were tapering in 2014 and completed it, they added another 13.69% in 2014. So the S&P appreciated another 13.69 during and after taper. So keep that in mind, which would be probably in line with we're going to have about 9-10% earnings growth next year. a 13% up market would be realistic. Probably a bit more bumpier than this year, though. We probably will get that 10% at some point, 10, 15% at some point next year. Now, and then lastly, I said, don't buy the finished product that's fully valued and everyone wants. Buy the quality, quote, dirt, and the skyscraper will come. There's plenty of dirt still available right now. This chart from Charles Schwab lays it out. It's amazing. While the general indices didn't correct more than 5% on a closing basis, the percentage of members with at least 10% correction from the year-to-date high, 91% of the S&P 500 components corrected 10% or greater. 90% of the S&P 500 members corrected 10% or greater, and 98% of the small caps, Russell 2000, corrected at least 10% from their year-to-date high. So that's why people felt so panicky in September, even though the general indices were doing fine, is because individual stocks got hammered. And that's why we said focus on the summer swoon. Some of these high-quality companies have gotten smashed. Buy them into year-end, and you're going to be rewarded. So the average member decline from their year-to-date high, so the average stock in the S&P 500 declined 17% from their year-to-date high. In the NASDAQ, the average member declined 38%. And in the Russell, the average member declined 34%. So that's some good data from Schwab, and pretty compelling thing to look at. And then I just closed out with there's still plenty of dirt still available right now. You just have to know where to look. And we've spent quite a bit of time covering those areas. A couple unusual options activity. I thought this was interesting from AT&T of all things. They're going to be a streamline. They got rid of the media, the HBO and all that stuff. So now they're going to be a pipe provider and the mobile provider and that whole story with 5G. I thought it was interesting. Someone came in and bought 42,000 contracts of January 23 calls. This stock has done nothing in months. It's cheap. I like it as a pure play now. I thought it was interesting to see that kind of volume in that type of name. And a few days ago, someone came in with almost 16,000 contracts of Alibaba for January at 150. There's been a lot of smart money coming into Baba, and we're seeing some more of that today. So if you get it back and fill, our views take advantage. But I think the trend is set now where this thing wants to push higher, and if it does so, it's gonna punish the people waiting for another retest because it's not going to let them in. It's just going to keep pushing. But we'll see. We'll take it day by day. That's why we do these on a weekly basis. Some economic data this week to go run through. Factory orders were better than expected. ISM non-manufacturing beat expectations. Non-manufacturing PMI beat expectations. 61.9 versus 60. That was good. Crude had a build. They build 2.3 million barrels versus an expected draw of 400,000 barrels. So that was negative. Continuing jobless claims were better than expected. So that'll be very interesting as it relates to the jobs report tomorrow. Because if you remember, Powell, that's the only report he has to look at before his November decision. Is he going to start tapering 2021, or is it going to get pushed off to 2022? He said he needed to see a decent employment report. Expectations are high. The expectations are at 500,000 payrolls. I'll take the under on that, but the numbers came in pretty strong today with continuing jobless claims beat expectations. They came in at less than 2.78 million, modestly, and initial jobless claims came in less with all these benefits rolling off. They were expected to come in at 348K. They came in at 326. So tomorrow, do we get 500? I take the under, and that gives Powell a chance to punt it to a December decision, which would be more likely. But, if this is strong, you may see the little weakness in the market tomorrow because it'll imply that the Fed's coming out earlier rather than later. My bet is that the opposite happens. So I think it'll come in light again for September. If you remember, the first half of the month, Delta mania, like you couldn't turn on the TV without pulling your hair out with fear. So my guess is hiring was a little lighter than expected the first couple of weeks of September, and that'll be reflected in missing expectations and Fed punting to the December meeting for their taper decision. So that's where it all stands. Want to thank you for listening in this week. We'll be back next week, same time, same place. In the meantime, make it a great one. Thanks for listening in.